That was the perfect way to start this week for bulls to get back on track with pretty much everything rallying, but tech out in front. Very key, as I highlighted on Friday. That's going to be the most important thing here. Keep it simple. Don't get distracted with the political stuff. Think about what's basically happened over the last 2 weeks. I'm not changing anything in my risk radar just yet. I still got the red light lingering from the risk of a higher correlation sell-off, which we kind of did get on Friday. Today was basically a full reversal of that, which is really good. But let's look at the chart, because I'm going to highlight some levels and some things to watch to give you my framework for this week. Firstly, just looking at the S&P over the last 10 days, so much has happened. It begins with inflation on the 11th. It includes an attempted assassination, which skewed political odds way in favor of Donald Trump. And then, with now the announcement over the weekend that Biden's not going to run, the odds coming down a little bit for Trump, we basically had a little bit of everything. And the main conclusion is that number one is we are lower, but slightly, since inflation on the 11th. The rotation didn't work out. That was the reason why I had the yellow light throughout it. Paid off as we unwound that strength, including a little bit of a fade in some of the rotation stuff. But most importantly was that just tech ultimately dragged us down. That's where it's the simple Occam's razor case for figuring out the market. Look what NVIDIA, look what the chip makers do, and the companies in that entire bubble. Maybe not the best word, but it is pretty expensive. They need to hold up for earnings. Technically, though, first, for the S&P, I'll put the yellow light back on. Basically, if we get anything like we got again today, one more time, about that 56.50, that's kind of where we had a lot of trading before we broke down. Seems pretty clear that was a big level, especially given what we talked about with the options flow with KG. Today was basically the minimum. Bulls had to have this happen today, otherwise risking major technical breakdown, major pressure on market makers. Instead, we got the rally that we needed. Perfect, okay? Great start to week. But that basically just kind of puts us back on an even playing field. What's more interesting to me is that still since inflation, the market's been going for higher beta, riskier stuff, up 2.5% over the last 10 days versus the high quality stuff, which is actually down. Quality is big tech. Quality is cash flow. Quality is dividends. It's profits. It's the stuff that I think still should be leading. And so when it's not, when investors are taking more risk and getting more speculative like we see with the high beta trade, that to me is the part that doesn't quite compute, given where we are with the economy, with the still ambiguity of what happens over the next several months for the Fed. I know the market says 100%, but is it ever really? And of course, the election and all that other stuff. The idea that now is the time to take more risk still doesn't add up to me. And so that's where we really need to see the tech stuff show up, because that's high quality. And this week is fun because we've got two main tech companies. One is high quality and one is high beta. Tesla's high beta and Alphabet is high quality. Alphabet only trades at like a mid-20s forward PE. Tesla trades at 100. Tesla swings like crazy. If Tesla doesn't give a good outlook on what they're bringing to the table with AI, the stock probably is going to get slammed. If the market likes it, we could easily keep ripping. And that'll be a good little microcosm of how to think about where we're at this point, because Tesla represents the higher beta, riskier trade. Alphabet's a little bit more quality. What you want to generally root for, of course, is both to rally together, and then that means you'd have like full-on animal spirits coming back in. The other option is you get one of them rallying, one not, in which case you probably want to root for Alphabet, because the high quality trade is what got us here, the reliability of profits and real product and real market dominance. That's what Alphabet represents. Would be great to have them both, but if you got to pick one, you want to see Alphabet rally. Now, finally, when it comes to the rest of the stuff, we've got economic data this week too, but I don't think it's going to move the needle quite as much unless you get big movements in the 10-year and the dollar. Basically, I've had the yellow light because on the dollar, because it keeps holding support. 10-year basically has been in the downtrend, but you still just haven't had a lot of real directional momentum on the macro side. You'd have to have the dollar break down in a really big way for me to think that the economic stuff this week is going to move the needle, or you'd have to have rates break down in a big way too, because I think generally for the 10-year yield, if you start to see some upside, you could frame that as a good surprise. Given the rotation went into companies that depend on the economy, good data should be received as good for markets, especially for the Russell stuff, as long as yields don't go berserk. But they're so far off the highs that I think the dollar and bonds probably take a back seat to our response to Alphabet and Tesla to determine if the market's high beta preference is still out of whack. If not, we need to correct it even more. So should be fun, a lot to process. I will see you throughout the week.